Good morning, everyone. This is Stuart. Hope you're doing well. Recording outside of the country, so hopefully the audio quality is all right. Quick summary of this morning's update. We'll cover tariffs, uncertainty, uh, S&P 500 valuations and outlook, and assessing your risk tolerance and liquidity needs, as well as focusing on fundamentals. Very quickly, disclosure, investing involves risk, and past performance is no guarantee of future results. With the tariffs, uncertainty is at a record high. The reality is no one knows what's going on. The administration is announcing policies that they reverse and then unreverse. So the situation remains quite fluid. U.S. economic policy uncertainty is at an all-time high. That is impacting both consumer confidence, which is at a 45-year low, and high above 6% for long-term inflation outlook. The S&P 500 did bounce about 7.5% last week on the news that the Trump administration was just issuing a 90-day reprieve to our trade partners other than China. It remains to be seen whether we can negotiate deals with those countries and what happens with China as well. The bond market, on the other hand, tumbled with 10-year treasuries rising from about 4% to 4.5%. What may be going on is loss of confidence in the U.S. as a safe haven. It could be leveraged investors unwinding positions. It might be foreigners selling, but in any event, bond prices at about 4.5% for the 10-year treasury is not ideal from an economic activity and financial tightening perspective. The S&P 500 is trading at about 20 times forward valuations. Earnings expectations are now at about 266 for the index. That's down from 270 a few weeks ago. The risk to the index is that we get an earnings contraction where we have earnings fall 5–10%, and also the multiple fall as investors lose some confidence in the U.S. That's not our base case necessarily, but we want to highlight that if earnings fall 10% and the multiple contracts from about 20 times forward earnings to the mid-teens, there could be additional downside. The U.S., in comparison to other markets, still trades expensively. There's a question whether that valuation premium is deserved after the last few weeks. Our stability is at risk, some might say, and whether we deserve to be trading at 20 times forward earnings while European countries and markets trade at mid-teen multiples is up for debate. If you rely on your portfolio for near-term cash, we still want you to ensure ample liquidity. Volatility is a great time to consider allocation changes that enhance the quality of your holdings. We think that the driver of forward returns is likely to shift from multiple expansion, meaning the price to earnings ratio moving higher. We think the key driver will be earnings per share growth. We want to focus on firms with sustainable growth opportunities that are not reflected in their valuations. With the sell-off we've had this year, there are opportunities emerging where that's the case. And in terms of where to invest, if you have a long horizon, we want companies that have a strong competitive position, stable operations, a good balance sheet, talented management, a realistic pathway to demand growth and valuation. If you have any questions, please don't hesitate to reach out. Thank you very much and have a great week.